And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the latter half, the second half of the month of June. Hope you had a very happy Father's Day yesterday. It is the 22nd least celebrated holiday of the year. Falls right behind Arbor Day. So if somebody celebrated your birthday, celebrated Father's Day yesterday with you, just means that you actually brought back the milk. That's all that means. So, all right. Anyway, a couple of things are happening. Obviously, over the weekend, a lot of stuff to get into. Iran, Israel, that whole conflict. I have an article out on the website this morning talking about historical conflicts in history, how the market usually responds, what happens, kind of going forward. And it's interesting this morning, the context of that article that we'll get into a little bit is talking about market responses initially. And this morning, market's already looking past it. After all the strikes over the weekend, the U.S. Embassy hit yesterday. Minor damage there, by the way. But again, markets are up this morning fairly nicely. Implied Dow opens about 180 points to the upside. S&P is going to be up this morning. So already the market's already looking right past this. Oil prices are down. So market's looking right past this conflict saying, well, basically this will be over in short term and I'd rather be in equity. So it just goes to show you how fast markets are now processing data. And again, a lot of the concerns over this weekend was like, oh my gosh, the markets are going to tank on Monday. Doesn't look to be that case this morning at the open. We'll see. I mean, things could certainly change. Midday, something happens. The U.S. gets involved into the conflict. It's a potential possibility, albeit small. But there's a lot of things that can happen. I mean, we're certainly not past this issue yet, and certainly not past the potential impact to markets, but as of right now, markets are just kind of looking right past this. Last week we had CPI and PPI data out last week, very benign. On Thursday was PPI. What we're seeing there is companies actually absorbing a bit of the tariff inflation. They're not passing it on to consumers, so we saw inflation drop in 41 of the 45 components. In the various indexes, we saw declines in inflationary pressure. So we're not really seeing a lot of push through there just yet, at least from tariffs. Now, the expectation is, again, from Wall Street, is like, well, you didn't see it yet, but it's coming. They've been saying that now for a few months. Hasn't shown up yet, but, it could. One thing that could certainly feed into CPI over the next, month or two could be higher oil prices. If this Israel-Iran conflict persists, that is going to bring up inflation on a short-term basis. That's not tariffs, that's just higher oil prices, which feeds into everything in the economy, from food to transportation to everything you touch, feel, smell. It all has oil in it somewhere. So again, higher oil prices will lead into a pickup in inflation. So it wouldn't be surprising that once we get into July and see the June prints for CPI, that we see an uptick in CPI either in June or July. Outside of that, though, there's not a lot of other stuff going on. We're about to approach earnings season here in the next 2 weeks. The share buyback window doesn't close entirely, but starts to close today. So we're going to lose a bit of that buying power that's been in the market here as of late. That's helped that one of those supports has been those corporate share buybacks. That will start to close out today. Again, that'll start in the financials, start moving towards tech over the next 2 weeks. So a lot of your major buyers, those are your big S&P 500 companies mostly. Those are the ones doing the majority of the share buybacks. That will begin to fade over the next 2 weeks. So just a couple of things to pay attention to. Now, outside of that, everything that else seems to be going on, the markets are doing okay. We wrote in this weekend's newsletter in particular talking about the bull rally continues. That's exactly the case. So here's what you need to know before the bell this morning. Looking at the markets, we've had a very nice rally, certainly still within this context of this uptrend. And, you can kind of see the market sold off a little bit on Friday just over concerns of, kind of this Israel-Iran conflict. Came down, tested the 20-day moving average. That 20-day moving average has been good support for this market. Every time you get pullbacks to the 20-day, that's been a decent point to where markets, start to buy stuff. But regardless of that, markets remain overbought. We are, started on Friday, tried to work off some of that overbought condition. Again, this morning, futures are pointing fairly higher. So again, what little bit of sell-off we had on Friday, maybe that's it for this whole kind of Israel-Iran conflict. Don't know yet. But again, we'll see what happens. There's still, a lot of things are in flux right now. A lot of things can happen. Certainly, if some type of shock comes up over the next couple of days from that conflict, that could certainly impact stocks. But again, as of right now, markets remain on very bullish footing at this point, and there's not been a lot that's been able to deter this bull rally currently, despite all the negative headlines, concerns about tariffs, inflation, whatever it is. This market has been really running contra to that, climbing that wall of worry, so to speak, and that's really been the case here. The one thing is that while retail investors are pretty much fully allocated to the markets, institutional investors still remain very underweight equities. Look at consolidated equity positionings across, kind of across measures of hedge funds, CTAs, etc. They all remain underweight equities. So again, there's this, as this market continues to try to push higher, every one of these little dips, like you saw on Friday, are getting bought by the professionals because they're having to get money allocated to the markets to be in the market. And that's particularly the case as we start to head up towards the end of this month, which is the end of the reporting period for performance for mutual funds, hedge funds, etc. So it's the end of the quarter. So this quarter end will mark their performance mark. They've got to report those earnings and or their performance, and they've got to report their holdings. So over the next 2 weeks, there could be some more buying pressure to the markets of them just trying to get allocated to the markets before the end of the quarter reporting period. That's not a guarantee, but just something worth paying attention to. Because again, with them being so underweight, that's certainly going to weigh on performance as they report out this quarter. Again, for hedge funds, mutual funds, etc., performance is key because everybody tracks their performance and it's like, oh, you didn't perform, I'm going to move my money over here. So there's a lot of what they call career risk to portfolio managers going into the end of the quarter because of potential underperformance. So again, that's going to potentially cause some more upside bias to the markets as they try to get allocated to make sure when they report, they show they have all the right stocks in their portfolios in that reporting period. Other than that, the other kind of big question remains the dollar here. The dollar's been under pressure. We saw a little bit of lift on Friday because of the conflict overseas. We saw some money rotate back into the dollar. But again, the dollar's been trying to base along this bottom here for a while. We're trying to work on setting a double bottom, getting decently oversold here on the dollar. So we're actually getting set up for a pretty decent counter trend rally to the dollar. And right now, there's a ton of negative sentiment on the dollar. So you've got a lot of short positions against the dollar. The short dollar trade is the most overcrowded trade out there right now, which is a really good setup for a counter trend rally to the dollar for whatever reason. Again, it could be ongoing conflict with Israel-Iran. It could be something else entirely. But something will cause a shift back into the U.S. dollar. And then once the dollar starts to rally, you get that short covering coming in. All these people that are offside the dollars have to cover. That gives you a potential decent rally in the dollar to somewhere from 97 up to around 102, 103. That would be a very good rally for the dollar. So there's a decent trade setup for the dollar sitting here right now, especially with it being as oversold as it is at the moment. So again, just kind of paying attention to that. Of course, a rally in the dollar works against potentially some of the kind of the international companies as well, because that strength in the dollar will start to attract foreign inflows back into U.S. assets as well. So rallying the dollar could help benefit the stock market even more kind of near term. Anyway, that's what you need to know before the bell this morning. We'll come back, talk a little bit more about Israel-Iran historic kind of analysis about what's happened in previous conflicts and what that means for the market. So don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th. With Ratliff and Roberts at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome to the show this morning. So interesting, there was an article out in the Wall Street Journal this morning talking about the one thing that's dividing portfolios more than anything else today than actually we've seen previously, which is political bias. And, you know, it's an interesting, and we're seeing this a lot in different data right now. For instance, in the University of Michigan Consumer Sentiment Index, inflation expectations are surging, but only with Democrats. Because when you break out the data and look between Republican respondents versus Democratic respondents, Republican respondents see lower inflation, Democrat respondents are seeing 10% inflation, right? Which isn't going on right now, but that's what they think, right? That's the inflation expectation. So when you take a look at that Michigan Consumer Sentiment Index, you have to discount that index of inflation expectations because of the political bias that is embedded in that index. So it's got a lot of problems with it. And that's why it also doesn't jive with what else is going on in the rest of the country with other data sets. The same thing is happening inside of portfolios as well. People are allowing their political biases to invade their portfolios, which has consequences. And it's always really important that when we're investing to set all that stuff aside. You know, for a long time, this was back in the late 90s, we were running money, and there was a movement that lasted for a very short period of time about no-sin stocks. And Wall Street goes through this every now and then. You know, we had no-sin stocks back in the late 90s, then we had ESG and all this type of stuff, right? So we go through these kind of narrative changes over time. And the problem is those tend not to ever work out well. And in fact, back in the late 90s, everybody was like, oh, don't own sin stocks in your portfolio. No gambling, no alcohol, tobacco. Don't own any of those stocks in your portfolio. Those were some of the best performing stocks going forward. And we saw the same thing in this whole ESG movement. And remember when BlackRock came out a few years ago and they're like, ESG is the thing, and you don't want to own any stocks that aren't ESG related, and those are exactly the stocks you want to own. In fact, ESG kind of died a very terrible death. So it's important to not let biases of anything, whether it's your personal views on different aspects of whatever, religion or life or personal preferences, political biases, etc., infect your portfolio. I don't care what your political biases are. That's for you. You can say orange man bad, orange man good, whatever, right? That's all on you, right? So outcomes are outcomes depending on kind of what you voted for. But when it comes to your portfolio, don't vote that way in your portfolio, because it typically tends to have more adverse outcomes than not. Because it's like, I'm not going to own energy stocks as an example. I'm not going to own energy stocks because Orange Man says he's going to do drill baby drill, and I'm only going to own solar stocks or green energy stocks. That may not work out well. So again, political preferences and political leanings are fine, There's nothing wrong with them, but just don't let it into your portfolio. Just, we need to go back to focus on earnings, forecast, what sectors are most likely going to benefit. And if you take a look at what's happening with artificial intelligence and data center build-outs and, electricity demand, there is a tremendous amount of money flowing into those areas. And those are going to be areas that make money, and those are not green, right? That's going to be natural gas, well, nuclear, obviously, but natural gas is not technically quote unquote green. But there's going to be a lot of demand for behind the meter usage of natural gas to power AI data centers. So again, it's just important to not let your political leanings impact how you're investing your capital. And there's an old saying like, well, investors can vote with their feet, and that's true. You can. You can sell all the stocks that of people you don't like, whatever, and that's perfectly all on you. But the question is are you helping yourself financially? Because at the end of the day, your investing is not about politics. It's about you. It's your decisions that you're making. And you're not, if you decide not to own some stock because you have a political bias one way or the other, and I'm not going to own that stock because of A, B, or C, the stock doesn't care because, I'm not going to invest in Target because remember we went through the whole Target thing a couple of years ago. Bud Light. I'm not going to invest in Bud Light because of whatever. That's okay. Bud Light doesn't care, right? Target doesn't care because you're not buying or selling their shares. When you're selling your shares of Bud Light or Target, I'm selling my shares of Target to Brent. So Brent likes Target. I don't like Target, so I sell my Target shares to Brent. That's the only people that are involved in that transaction. The company doesn't care. So the only person it affects is you. Now, you may be right in your decision. I'm not saying you're going to be right or wrong, right? I'm saying the only person it affects is you. You may sell Target because you don't like what they did, or you may sell Bud Light because you don't like what they did. And those stocks did go down after the fact. So in that case, you were smart and you made a good decision. So I'm not saying that every decision you make is going to be a bad one, but all I'm trying to get across to you is that the only person it affects is your wealth. So we need to make sure that when we make these decisions based on political biases, that I'm more right about the consequence. I don't like what, the president is doing relating to this sector of the economy. Good example, drill baby drill. That's not really good for energy stocks because if you're going to drill baby drill, you're going to increase supply more than you have demand. That's going to bring oil prices down. So maybe your decision based on that is I'm going to underweight energy stocks in my portfolio because of potential supply demand issues, and that's okay, right? That's not really a political issue. That's a fundamental issue based on a political decision. That's okay. I'm not saying you shouldn't pay attention to what happens politically, but just make sure that you're not allowing your political bias to just say, I'm not going to own any of these stocks because this person likes them in politics, right? That has more of just an impact on you and your future. So anyway, there's an article in Wall Street Journal that kind of goes through it if you want to go read it. But again, just as is always the case, and as we talked about a lot, the worst decisions that we make as investors are the ones that are driven by emotions and not facts. And you got to be careful because a lot of the stuff that's printed in the media is not factual. I got this tweet this morning as a good example of this. There was an article on MarketWatch talking about the Fed is secretly doing QE behind the scenes. The Fed bought $34 billion in bonds last month. And so I'm getting all these texts from people going, the Fed's doing QE and they're just not announcing it. They're doing stealth QE. No, they're not doing stealth QE. They're still doing QT. All they're doing is buying the bonds that are rolling off their balance sheet in excess of the $5 billion that they're letting mature every month. So if $30 billion matured this month, they're going to buy $25 billion in bonds and let $5 billion mature because they're going to keep their balance sheet rolling off at $5 billion a month. But again, see, that's a false narrative. And this is why just because it's printed in the media doesn't mean it's true. And it doesn't, and particularly today more than anything else, when so much of the media is biased in one direction or the other, you've got to really be careful about sorting through what you're reading to make sure it's actually factual. Because there's a lot of people that are out there just writing articles about whatever the headline is. They're going over to ChatGPT and they're saying, write me an article on, how tariffs are going to cause inflation. Well, ChatGPT will write you one, right? And then they print that. It's not factual, but that's what they're printing. So you just have to be careful with what you're reading, where it's coming from, what the source is, and make sure you're doing your analysis. And that's why it's so much of our work that we do on Real Investment Advice is to go through here's the historical data. Here's the facts behind this. Here's a chart of this, that, or the other thing that shows these relationships to help you make better decisions about what you're doing with your money. And again, set the other stuff aside. Stuff that's emotionally driven, emotionally charged, those typically work out not well for you more often than not when it comes to building your wealth. All right, quick break. Be right back. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So futures still pointing up this morning. S&P's up about 40 points right now. Implied open's 42 points. Nasdaq's going to be up 170 at the open. That's assuming everything holds here for the next hour and a half before the market opens. So, but right now futures are pointing to the upside as, again, as we talked about earlier, markets are kind of looking through this whole Israel-Iran conflict. And to be honest with you, I'm a bit surprised after kind of the escalation over the weekend. I thought for sure the markets would be lower. And if I was going to bet you, right, Sunday night, I would have bet you that futures would have been, lower by at least a percent or two today, just under the assumption that this could cause big spikes in oil prices, a whole variety of things. But it's not happening. Oil price is down this morning. Gold's down. Kind of your safe haven, and kind of bids for conflict. Those are down this morning. Stocks are up, and that's really been kind of par for the course this year. In particular, retail investors have been very aggressive about buying stocks this year so far, and it's kind of there was a while there coming out of 2009, and then once we started doing QE1, QE2, zero interest rates on treasuries or Fed funds rate, treasury yields were very low, 2.5%. We came up with this acronym called TINA, which is there is no alternative to stocks. And so everybody was from 2011 really all the way through 2019. Everybody was piling into stocks because there was really no yield on bonds of any consequence. I was getting a higher yield I could build a dividend portfolio of stocks that were yielding higher than treasury bonds during that period of time. So there was no alternative to stocks. Makes complete sense. What's interesting today is despite the more elevated risk in the markets, this idea of TINA has returned. But it is different this time. I get a 5% yield on treasuries for doing nothing, taking no risk. So there is alternatives to stocks right now. But retail investors have been so trained over the last 15 years to buy stocks, buy every dip. The Fed's going to bail it out. But this is the interesting thing this time, right? You've got the Federal Reserve doing exactly the opposite of what they were doing previously when TINA was all the rage, right? Fed funds rates are, 4.3% right now on average, midpoint. Treasury bonds are yielding 5 on the short end. So there are alternatives. Stock valuations are high. Really the equity risk premium for stocks is near zero. So this is a very different backdrop than what we saw previously when TINA was in action. And it made sense. TINA made sense before. It doesn't make sense now as much. But we've trained investors, particularly retail investors, to chase stocks. And more importantly, we've trained them to chase the most risk possible. And this is why we see options trading kind of going through the roof right now. We see, the inflows into U.S. equities has been very strong, but primarily we've seen a lot of inflows going into leveraged ETFs. So not only have we taught retail investors not only to make sure they're invested and to invest in the stock market because the stock market always goes up, we've also taught them to do it with leverage and increase their risk profile even more than what they were doing previously. Now, this has bad outcomes written all over it eventually, right? What causes it, what triggers it, I have no idea. But there is this attitude where retail investors are becoming extremely confident in their ability to navigate markets, which historically does not work out well. And I mean, we've seen periods like this in the past. Late 90s was very similar to this, where you just had investors chasing everything. And people were just sticking .com at the end of their name and people would buy it and push it up in price. So we've seen this type of real speculative behavior before, and it doesn't end well. And this probably won't be any different this time. There will probably be as my dad would say, a come to Jesus moment at some point in the market where reality will set foot. Here's an interesting, kind of case to watch right now. Nuclear power has gotten a lot of footage lately because of AI data center build-outs. We've talked about it. Everybody's talked about it. But Oklo is an example. Let's just use Oklo as an example. Oklo makes no money. They have no income whatsoever. And they're losing about $500 million a year. It takes 10 years to basically build a power plant, get these things up and running. So this is going to be a very long-term process before Oklo gets power plants built, operational, they start making revenue, all those type of things. So, all the forecast for the company will turn out to be true at some point. But it's a very long process to get there. And the price has had just a phenomenal run up in anticipation of this very long-term projection of revenues. So there's a real risk between now and whenever they get their first power plant online and start generating some revenue that, there could be some event that occurs. President Trump comes out of office, new president comes in, new president gets elected. He's super green energy, solar, wind. He says, we're putting regulations back on, I'm just making stuff up, but we're putting a lot of regulations back on nuclear power because it's not safe, right? Whatever. All of a sudden, those stocks are going to get killed, right? That can happen. See, what I'm saying is people are betting right now on this long-term projection of something to come to fruition in the future that has a big risk to it. But right now, investors don't see that risk. They're just like, it's going up, I'm going to buy it. And that's just a very dangerous kind of aspect to managing your own personal wealth. And again, as we talk about here, all we're focused on is how as we were just talking about in the last segment about political bias, right? Don't let that infect your portfolio because, again, the only person it affects is you and your wealth. So if you make the wrong decision on political bias or fundamental bias or whatever it is, you make the wrong decision. The only person it affects is you. It doesn't affect me, doesn't affect Brent. We don't care, right? Well, I do care if you hurt yourself, but yeah, Brent cares. We do care if you hurt yourself financially because that's why we're here. We're here to help you. But the only person it affects is you and your family. So we need to just make sure we're making, the best possible decisions. And I'm telling you, I have not seen retail speculation like this in a very long time. Again, the last time I remember retail speculation of this magnitude, we saw a good bit of it in 2021. Remember, we were all chasing SPACs and all these other kind of shady issuances coming out of Wall Street. And we saw a good bit of speculation there, but it wasn't even to this degree that we're seeing now. And the last time that I've seen this type of speculation really was back in the late 90s with the dot-com stocks, which just goes to show you how old I am. And Brent. I remember when, there was a lot of speculation around the invention of the light bulb, so not really. I'm not that. I made a comment the other day and somebody actually, Brent, came out and said, Lance, you weren't even alive back then. I know. I was joking about how old we are. Yeah, it's a metaphor. I wasn't around when Thomas Edison invented the light bulb, but I remember the speculation in the markets. Clear as a bell. So yeah, don't take everything so seriously. Some of the show here is for entertainment value purposes only. We should have a disclaimer. We give you factual information, except for the entertainment parts. Those may be slightly embellished, for sure, in some cases. Unless it involves my wife. That's always the straight truth. In most cases. Anyway, just be careful speculating in the markets. Again, markets are very bullish right now. The trend is very positive. It doesn't seem like anything can derail this market. Israel and Iran, whatever. People want to be invested in the markets. Hedge funds are trying to play catch up right now. again, there doesn't seem to be anything to derail the market momentarily, which is exactly the time that you need to start paying a little bit closer attention to your portfolio, because this is typically where, when investors are not willing to pay for insurance in terms of hedging their portfolio, that is typically the time the market corrects for one reason or the other. And again, if it's not Israel and Iran, it'll be something else. Apparently, Israel and Iran isn't the thing. But we'll see. Again, there's still a lot of stuff that can happen between Israel and Iran over the course of this week. Also, this is a holiday shortened week as well. Thursday, markets are closed. Is it Thursday? Is it tomorrow? Markets are closed. June 3rd, Juneteenth is tomorrow? So markets are closed tomorrow, I think. We'll have to check. I don't think so. I'm not sure about that. We may or may not be here tomorrow. Depends. Anyway, have a great day. We'll see you back here on the next edition, whenever that might be, of the Real Investment Show. Have a great day.